In this week's Property Insider Chat, Dr. Andrew Wilson and I discuss the latest vacancy reports and rental reports. And while vacancy rates are creeping up a bit, there's no relief in sight for tenants yet. We also discuss the latest inflation figures and what they mean for interest rates. And as usual, what's happening on the ground at our auctions around Australia. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Last week, we reported My Housing Market's end-of-month figures for July, showing that property prices continue to rise around Australia. Nationally, house prices have risen for 17 of the last 18 months, meaning many first-home buyers are facing a heartbreaking battle, and it's doubly hard because rents have been skyrocketing. In today's Property Insider Chat, Dr. Andrew Wilson, Chief Economist of My Housing Market, is going to share the latest My Housing Market rental report. So let's see if there's any relief in sight for tenants who are renting. Hi, Andrew.
Yes, good day, Michael, and maybe some better news with the latest rent report. We have been seeing a general trend where vacancy rates from those really remarkable record lows have started to increase, get higher, and we're seeing that continue. As we've discussed, these terrible rental conditions really couldn't last, particularly in terms of the numbers, because we see social changes starting to occur when the rental market becomes virtually a lockout, which it is for many, and they start making different decisions in terms of their accommodation choices. Perhaps they live at home longer, perhaps they consider sharing with other groups, perhaps they move to regional centres. But this is the nature of, when we have this terrible undersupply of property. And Australia's not alone. This is a global issue, particularly with advanced economies where we've just sort of underbuilt. And of course, the bounce back from those lockdown periods through COVID with higher migration has just added to that problem. But we are starting to see an increase in vacancy rates. Whether that, I'm not sure that's an increase in supply or a reduction in demand. I think that we've got a couple of factors working there, and that, as I mentioned, is a choice change from prospective tenants. But also we're in winter as well, and the winter months are always lower in terms of demand, not just for rental property, but also for property generally. And maybe we're seeing that also influence results. But yes, vacancy rates are creeping up. They're not below 1% generally now. They're still they're above 1%, but not yet, particularly for houses, getting close to 2%, which is a bit of a balance between supply and demand we use as a measure, a rough measure. But and units are still, the vacancy rates are higher, and they're maybe moving a bit closer to 2%. But the point is, Michael, they're still reflecting a market where there's not enough supply and too much demand.
Well, we know that there's very little in the pipeline, as we've had chats in previous Property Insider weekly sessions where, at the moment, I agree with you. I think winter times diminish demand a little bit. We know that investors are back in the market when you look at finance approval figures, but not to the point where it's going to create sufficient supply to meet the demand, is it?
No, I think we're just sort of heading back to a more balanced market, but we're not there yet, Michael. And the numbers are still certainly in favour of landlords. And the other point is that with these high rents, it's very difficult for prospective tenants to keep up with rising rents at the rate they've been rising over the past year or so. And that's because, incomes just aren't growing that quickly. So that, sort of acts as a bit of a levelling off factor. But, I think the next few months will tell the story, whether we are getting back to a more balanced market environment, but there's still a lot of question marks as to whether that will occur in the near term. We're really not seeing a big increase in supply coming through. A little better for houses, but units are still, quite depressed. New unit development is quite depressed, and that'll take some time for it to work its way into the rental market. And as you said, investor numbers are certainly picking up. Investors are quite, the appetite for investment properties is growing, and why wouldn't it would be with, tight rentals still low vacancy rates and higher prices. That's obviously acting as a hook to investor activity. But whether that'll rebalance the market in the shorter term, I think is problematic. But the next few months will tell the story there. But even though the market's easing from what's been just really crazy, a crazy tight rental market, a record tight rental market, to something that's still tight, but not quite as bad at the moment.
Well, the big news over the last week's been inflation, and by the time most people watch this, there's also going to be an interest rate decision. Did the inflation figures that came out last week surprise you?
Not really, Michael. We've been saying that it's important to look at the price of oil in relation to inflation outcomes, and we have seen a pickup in the annual change of oil prices, petrol prices, which has worked its way into higher inflation. But we had some relief. Headline inflation was down to 3.8% over over June. And that followed a 4% result over May, so down 0.2%. But underlying inflation is the measure that the Reserve Bank uses in terms of its interest rate policy, and that actually increased. That was up from 4% in May to 4.1%. This is the annual change, of course, on a month-to-month basis, Michael. So that's not good news. It was another rise in underlying inflation. And I think the key thing to remember here, Michael, is that the Reserve Bank target remains 2 to 3%. So still a long way, really, from that benchmark, and heading in the wrong direction. And of course, underlying inflation takes out the volatile elements of the basket of goods that are used to measure overall inflation, and that's typically petrol and food costs. And I think one of the reasons we saw the headline rate fall was because we had an actual improvement in the annual growth rate of fuel costs. They were up a very strong 9.3% over May. And even though it was still an increase, it was 6.6% increase over the year to June, Michael. So that was an improvement in that. And I think that, was a key factor in terms of a lower headline inflation rate. Although housing was up again 5.5%, which was higher than that 5.2% recorded over May, and food costs were flat at 3.3% annually. So there's some reasons why we saw that decline in the headline rate, most notably an easing in the annual price of fuel. But it's the underlying rate that's the important one here, and I think that's giving the Reserve Bank some headaches because it's moving in the wrong direction, and it's still well ahead of the target of 2 to 3%. And the Reserve Bank has clearly said that it needs a sustained period within that target range for it to start to think about, hey, we've finally conquered inflation. So a sort of a mixed result there, but probably not one that the Reserve Bank is looking for, because I think it'd be very reluctant to raise interest rates going forward. But if these numbers continue to follow the recent pattern for underlying inflation, the Reserve Bank may have to rethink its current outlook. But generally still not good news here. I mean, even though it's a reduction in headline inflation, it's still at 3.8%, something that people wouldn't be very comfortable with. We need to see some clear improvement going forward here before we even thought of a change in interest rates, particularly downwards, a cut in interest rates. And we're still well ahead of where the US is in terms of our inflation rate. And the US are probably now more inclined to be thinking about a cut in rates, although I still think that that's a bit of an outlier. It will depend on the data coming through. But it's certainly in a a better position to be talking about lower rates than Australia is, which is sort of way off those sort of discussions at the moment. But
Well,
yeah, and it is,
interestingly,
once
Andrew, the
again.
big four. Interestingly, Andrew, the big four banks have changed their forecast about when interest rates are going to fall. Now, we know it earlier this year, most of them forecast they'd already be starting to fall. So we know how useful these forecasts are. But the Commonwealth Bank and Westpac both believe November is going to be when interest rates start to fall in Australia. ANZ believes it's going to be in February 2025. And National Australia Bank's the most pessimistic, believing rates won't start falling till May next year. So I'm sure once again there's going to be continual changes to these forecasts, but none of the banks are proposing or suggesting there's going to be a raise in interest rates in the immediate future.
Well, these forecasts are a little bit ridiculous, Michael, because they're so dependent on the data coming through. The longer term forecasts, become even more problematic because, they've got to rely on a volatile data set,
Yes.
and we can only, that's why, we don't do that here, because we know that the data can change. We've unfortunately got, some more issues in the Middle East now, which is looking, worrisome for sure. And of course, if we get a spread in or a Middle East conflict, that's really going to affect the price of oil, and that would, as we've discussed, have a significant impact on inflation. And how can you predict where inflation is going to go when we have such a period of flux in terms of not just the data, but what's the background, what's driving the data going forward? But certainly the results now are not conducive to lower rates in Australia in any sense. Our economy is still very strong. Retail sales are still strong. We go through all the usual suspects that the economy is performing very, very well. And underlying inflation, the Reserve Bank's preferred measure, is actually going in the wrong direction. But, we've got to consider that the banks have a vested interest in their forecasts, and, the fact that they jump up and down their forecasts generally, not just for interest rates, but for the housing market, means that, we have to take everything that the banks say with a big bag of, or a big bucket of salt, to going forward. But like, as I said, I don't think the Reserve Bank would have been very happy with these results. But they're being very conservative, and I think that's the thing to do going forward. And I think that, that's a good thing in a sense, because it maybe, reveals the prospect of a lengthy period of rates on hold, which I think can be a good thing, particularly with our economy is so strong at the moment. The added equation into the US discussion on interest rates has been some perceived weakening in the US economy, but there's still, some ifs and buts about the data that's come out. But, I think listening to American economists and the American media about the state of the economy and finances and the direction of interest rates really is, an exercise in fantasy to a large degree, because if we talk about vested interests, there's plenty of those that are pumping a particular point of view when we talk about the US economy. But as I said, I think that we're in a position of, wait and see still with the Reserve Bank going forward.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, Our advice is independent and unbiased. Now, we've moved into August and it's almost spring selling season time. The property market tends to quieten down over winter, and we keep a track of the auction results every week. And
Yeah.
interestingly, even though it is the quieter time of the year, auction numbers and auction results and the depth of people going to auction has held up pretty well over the winter time. What happened last weekend, Andrew?
Well, absolutely, Michael. It's been, as we've seen all year, it was a strong autumn, and we've seen in a relative sense a strong winter. Listings have held up. Clearance rates are still quite reasonable, and in some cases strong. During the midwinter period. Usually we see the depth of the market the first couple of weekends in August, and then we start to see the revival coming through with higher listings and clearance rates. And it's sort of, working to plan a little bit at what we would expect when we started August at the weekend. Numbers were a little lower, clearance rates maybe a little lower, but it still had some pretty positive signs in terms of the strength of the winter market. And as we've mentioned, it's not just about it's too cold to go out and buy a property. It's sort of it's not about the weather. It's
No.
about the seasons, that we typically in autumn, buyers and sellers make seasons from the beginning of the year because they want to start off the year with what they've discussed over the break, the Christmas, holiday break. And that gives us the autumn selling season, and that sort of runs out of puff depending on the cycle in the middle of the year. Then we have another break, of course, the mid-year break. And then through August, we see those decisions being made in regard to buying and selling before the end of the year. So that gives us the spring selling season. And that's why we start to see that revival in late August. But it has been in terms of the site. And the other point is that we see typically through the winter months a much higher proportion of mid to lower price properties because the top end of the market, they're on holidays, if you know what I mean, because they can afford it. And we also see a higher proportion of non-discretionary sales during the middle of the year. Divorce, job changes, a death, these types of scenarios, because of the lack of higher priced properties, become a larger factor in market dynamics, and that can mean lower prices going forward. But depending on the cycle, of course. But look, another positive weekend for the first weekend in August. In a way, it was maybe comforting that we're starting to see what we would expect to see at this time of the year, and that gives us the platform for our usual spring bounce back. So let's have a look at the results. Sydney auction numbers were down by 100, down to 596 listings. Also quite similar to where we were a year ago in Sydney, where they had 613 auctions over the same weekend. So, bit of a normal market, we could say, in a sense there. The clearance rate was also down in Sydney, 69.7%. Again, just reflecting that sort of winter blues scenario. But of course, we still had high clearance rates a year ago through that winter period because that was the revival market, as we've discussed, that continued through autumn and into winter. But as I said, I think a reasonably predictable result there in Sydney. For Melbourne, the Melbourne market's actually holding up, Michael, through this period. And I think it's because the Melbourne market really is about those mid-price range markets, which are less affected by that seasonal impact of winter. 790 auctions in Melbourne last weekend, which was similar to the previous weekend, 813, but still well ahead of where Melbourne was a year ago, Michael. At 663 listings, and the clearance rate not too bad. It's continuing to track in the mid 60s, Michael, that Melbourne auction market, which is still maybe just in favour of sellers, but certainly it is those lower to mid price markets that are still performing well. And the top performer, regional performer in Melbourne, was again the Outer East, which is typically the strongest market in Melbourne and is a mid to lower priced market. But clearance rates down compared to a year ago. But as I said, in relation to Sydney as well, that was a strong period of the market in terms of the cycle. Brisbane listings down a little bit to 100 versus 111. Still good numbers there, but Brisbane doesn't typically is not typically impacted to the same degree as Melbourne and Sydney by the winter market. And that's because Brisbane doesn't have the same strata in terms of a prestige market at the same level as Melbourne and Sydney do. So they're not as affected by the change in the winter mix of property types. 62.8% result in Brisbane. That's a strong result for Brisbane, and well ahead of a year ago, and listings well ahead of a year ago in Brisbane as well. So that Brisbane market keeps on keeping on, Michael. It's been one of the strongest performers consistently
hasn't it,
this year, and no sign really of slowing down. And it's usually a stronger market in the second part of the year seasonally in Brisbane, depending on the cycle, but still a strong market in Brisbane. Adelaide has really left behind those 80 to 90% clearance rates that we were getting weekend after weekend in Adelaide. Still a good result there for sellers, a little bit higher than the weekend before, 70.8% clearance rate. So maybe a little bit of the steam running out of that Adelaide market. Still a good market. Prices are growing, a good market for sellers. And listing numbers were actually higher in Adelaide and well ahead of where they were a year ago. But the clearance rate well below where it was a year ago, which was almost an absurd result, 88.9%. But Adelaide, a little bit again of those winter issues in Adelaide. And Canberra bounced back, Michael. We've been saying that there were clear signs of a revival emerging in Canberra over recent months. It's been a bit up and down. Last couple of weekends have been a little bit less than what we saw through the beginning of July, but numbers similar in Canberra. 61.6% clearance rate in Canberra, a good result, not as strong as a year ago. Again, that cyclical force was much stronger a year ago with the revival of the cycle, but some more positive signs in terms of a revival in that Canberra market, which really did move backwards to some degree over the second part of last year, maybe reflecting some changes in local government property policies during that period. So we look at the trends, looking a bit winterish, those trends, Michael, just dipping down in Sydney there with last weekend's result in August. It's only one weekend, of course, but the Sydney market really has held up right through the year with those clearance rates all above 70%. With the exception so far of August, but still very close to 70% nonetheless. Melbourne market has been very consistent in the 60s this year. Certainly not as strong as Sydney, but, just holding its own to some degree, Michael. And I do think, again, that reflects the diversity in results between mid to lower prices and higher priced property regions in Melbourne, which have been clear underperformers, but still tracking at its highest level there for some months so far in Melbourne, and we remain interested to see what happens over the following weekends. Brisbane, big result there, just one weekend, of course, and the highest results there in Brisbane so far for the year. So we'll see how that pans out, but still a strong market in Brisbane. Adelaide has just started to come off the boil from very high results, auction clearance rates, monthly auction clearance rates results. But again, still a positive market in terms of sellers versus buyers, for sellers, I mean. And as we mentioned before, Canberra still now starting to look a little bit more promising with a revival over the month compared to the previous month so far in August compared to July. And we'll have to wait and see whether that continues to consolidate. If you're looking for those auction clearance rate results, you can go to my LinkedIn channel, Doc Andrew Wilson at LinkedIn. Every Saturday, 6:30, we give the headline capital city results. And if you're looking for the full national report, which includes the regional breakdowns for Sydney and Melbourne and the top 10 sales under the hammer for all the capitals on that Saturday, you can see those released also on my LinkedIn site, Doc Andrew Wilson at LinkedIn on Sundays. And Michael also produces that exclusively through his channels on Sunday as well. And if you've missed out on that auction market report, either through Michael or myself, there's a QR code if you've got the screen up, which will give you a PDF file to link. So that's all we have for this week, Michael. Interesting week. And it works its way into what will be a very interesting week with the Reserve Bank meeting in terms of interest rate policy.
Yes, it will be. So I look forward to catching up with you this time next week when we can unpack all the news. Thanks for your time, Andrew.
Thanks, Michael.